Cam Albright, high yield has really come back since mid-February following the rise in equities. So where are valuations now?
I think you'll find that overall, as you look at the prices that have come back and certainly gone back up probably, maybe 4 or 5% or so if you look at the price returns that you're looking at in the index right now. So you're probably in a position where they've come back about halfway, maybe at this point in time. So I think there's still some good values out there to be able to take advantage of. There's still some markets out there that are stressed, like the energy market. Some of the markets that are more closely attuned to what the consumer is involved with have probably done fairly well. And they're probably a lot more stable places to be in the high yield market at this stage of the game.
Can you talk a little bit more about what's going on in the energy sector? Because people are expecting a lot of defaults as the months progress. Will that infect the rest of the market?
Well, I don't think it's going to infect the rest of the market the way it was perhaps positioned earlier this year. I think there was a lot of fear that that would take place. But I do think you're still going to see some pretty strong defaults, a rise in that particular area. Oil has come back, it's up about 30%, but then again, when you started at a $26 base, that's a pretty small dollar increase all considered. But so there is maybe some benefit to that, but I still think you're going to see a number of defaults out of the energy area as the year progresses.
We saw a lot of the energy companies issue stock recently. Why don't we talk about the supply of high yield bonds? We're going to start seeing some more high yield bonds hit the market?
I think that in that regard, you may see, it all depends upon what your financing needs are. I think that one of the things in a broader scope that you have in the financing is the fact that 2016 is not a big year with a lot of maturities taking place across the high yield spectrum, so that may be of some benefit. But I do think that if yields are starting to come down, people may hold off, see if they can get better terms. Those companies that do need it are going to be perhaps having to enter the market at a sort of a disadvantageous time at this point. And
one would think that the more dovish Fed we heard from this week should also be a tailwind for high yield.
I would think so too. The fact that the Fed went ahead and sort of walked themselves back from at least 2 rate hikes this year, that's a pretty remarkable thing that they've done when you consider the fact that they in the street have been really, I think, pretty much at odds as far as what was going to happen. And I think that that's a pretty remarkable thing. Sort of puts the Fed in a much better position relative to where the street is, and I think will provide a tailwind. I think they've really indicated to the market that they recognize that there needs to be a better cohesion of where they are and where the street is thinking that they should be.
All right, one of the things we've been hearing when it comes to high yield is that active management is a better play than some of these indexes or ETFs we've been hearing a lot about.
Right.
Give me your view on that.
Absolutely. This has been our view that active management is critical, and it comes down to 2 words: credit research. That is the main thing that we think really drives the ability to get the best out of the high yield market. You have to be able to do, or have somebody who's providing you with the credit research to really dig in, find the opportunities, avoid the traps, and that's the best way to deal with that market. You can't really survive it very well. If you buy an ETF, you get all the bad stuff with the good, and that's no way to really get yourself ahead.
All right, well, thanks a lot, Cam.
Thank you.
And thank you for watching The Street.